So, very warm welcome to our viewers to the Outlook Money webinar series. This is a part of the Investor Education and Awareness Initiative of Aditya Birla Sun Life Mutual Fund in association with Outlook Money. I'm Nidhi Sinha, editor Outlook Money, and today our topic of discussion is the art of asset allocation, which I think is very, very relevant in the present volatile times. So, but before we start discussing the topic with our experts today, let me first introduce them to you. So first of all, I would like to welcome Mr. K.S. Rao, who's the head of Investor Education and Distribution Development at Aditya Birla Sun Life AMC. Mr. Rao intends to take financial literacy and investor education to various demographic segments across geographies, and he has been working relentlessly towards that over the years. And he has spent more than 2 decades in the mutual funds industry. We also have with us Mr. Amit Trivedi, who's an author, speaker, blogger, and trainer. He has over 26 years of experience in the capital markets, and he has authored a number of books, the most recent being Money-Wise Perspectives for Women. Last but not the least, but I would also like to introduce Mr. Vinod Bhatt, who's a portfolio manager and equity strategist, again at Aditya Birla Sun Life AMC. Vinod comes with an experience of 2 decades with close to 15 years in the financial markets and investment banking space. So, and Vinod recently wrote a book which was, which talked about asset allocation. So that is also going to be very relevant for us in this session. So welcome to the webinar series, gentlemen. It's a pleasure to have you on the show.
Thank you.
So now for today's topic, asset allocation is something that, can help investors tailor their needs, their investments according to their needs, if I may put it like that. And often we see that, sometimes it is ignored, but it is one of the strategies that can give best results. That's what experts have been saying in the past. So, for instance, the market is really volatile these days, and an investor who really has his or her assets allocated in different kind of instruments and investments may not feel the pinch that much. So our experts will elaborate on this concept and make us understand in more detail. So I will start with Mr. Rao, and let's start from the basics for the viewers, Mr. Rao. So what, according to you, is asset allocation? If you could explain that in a bit of detail.
Thank you so much. Good morning, Nidhi. Good morning to my co-panelists Vinod and Amit, and glad to be here. I think we took a little longer gap for this webinar series, and glad we have started. Thank you so much for it. And indeed, the topic is very right at this point of time, the art of asset allocation, because when markets are volatile, we think of asset allocation. Otherwise, asset allocation is always need to be thought. And as you mentioned earlier about Vinod Bhatt's book, he has mentioned very nicely, the book is The Financial Independence Marathon. He said the first step to start your marathon is to have an asset allocation. That will lead to the last step. And let me explain in a term what exactly the asset allocation. We speak many a times what exactly it is. It is just a simple methodology to construct an investment portfolio. It is to diversify the assets, diversify the money among the various assets. It is, funds you are allocating to these assets to get the desired results, and with desired returns with the appropriate risk what you are. Of course, that's not exactly the risk, I can say. The goal is to the reduce risk, and goal is to the enhance or optimize the return. And why we do this is because very different investment categories will behave very differently. And that's a periodically, when there is every asset class is a cyclical in nature, and different economic cycles or the different events happening, whether nationally or internationally, or it is to the demand and supply. These asset classes behave very differently. While combining these asset classes, you are optimizing. One is minimizing the risk and optimizing the returns. And to put it in a nutshell, when I do these college programs, I ask the students, if they ask what exactly the asset allocation, I put it to them, how many of you go to the bakery? And what you do is you ask for a cake. And if you ask the cake, the wonderful one which you are eating, but if you can bring the same cake you want to prepare at home, probably you need to go and ask the chef what he did, what kind of right mix he did, whether it's a flour, sugar, or like, essence or whatever the ingredients, and the time to bake that cake and time to bring and give it to you and serve, which is the final cake which has come to you. Asset allocation is something like, you're baking the right investment with the right appropriate mix of these assets. And put it in a simpler definition, it is you are just diversifying, you are mixing these assets in such a way, you are creating a safe, solid foundation for your portfolio. And I recall from my academic days, the asset allocation which we spoke, I mean, whether it is a modern portfolio theory to put it, I mean, it's about, most of us would have read about our portfolio management, about Harry Markowitz, who won the Nobel Prize for this portfolio construction. Probably from 1952 to 1972, when he won the Nobel Prize, probably we spoke more of the times asset allocation, but I have not find someone who follows with a discipline and with a commitment. Probably if we can stick to the discipline and commitment, this will become a key for our investment planning. We all do investment planning, and the element of the investment planning is, once you start, the first step, as Vinod said, is to have a right asset allocation, but right asset allocation followed by the right discipline and also a right commitment. And before Amit coming in with a Bollywood examples, let me conclude the saying art of asset allocation, which is I call AAA. That is, in a Bollywood example, is you have Amar, Akbar, and Anthony. You have a wonderful play to enjoy your investments.
So right, Mr. Rao, another interesting example, another session. So of course you have to bake the cake right so that it tastes right and serves you right, of course. And so coming to you, Mr. Trivedi, I'll pull you into the discussion, and we were talking about the volatile markets, etc., which is the current environment, not just in India, but all over the world. So how do you think asset allocation really makes a difference in this kind of environment?
Let me start with a negative answer. Asset allocation does not make a difference. Following asset allocation makes a difference.
Okay.
Yeah. So if somebody and then I picked it up from Rao sir's answer, because he used a particular word called discipline. Now, if discipline is missing, if that perseverance is missing in following that asset allocation through the ups and downs, through the good times and bad times, then it doesn't help. Consider that, and as Mr. Vinod Bhatt has written in his book, beautiful book, that this is the starting point. So let me put this question back to our viewers. When do you buy a fire extinguisher? Not when the house is on fire. You have to buy it much in advance. So asset allocation is not something that you do when the markets have turned volatile, when everything is falling down. That's not the time when you think of asset allocation and do it. That is an indisciplined way. You do it right from the word go. And that word go means if you didn't do it yesterday, do it today. But start now. Don't wait for the markets to turn nasty. Because the way asset allocation helps is, and looking at the current markets, even after following the right disciplined investment approach, you can't really stop the markets from falling. And that's what I would quote that beautiful proverb which says, you can't direct the wind, but you can adjust the sails. So it is the adjusting of sails where asset allocation comes in.
Okay, thank you for that perspective, Mr. Trivedi. And now coming to Mr. Bhatt. Mr. Bhatt, like Mr. Rao, also you also have spent a long time in the mutual fund industry. So coming to mutual funds in particular, how do you think mutual funds can really help a person, an investor, a retail investor, do and follow proper asset allocation?
So Nidhi, I think the mutual fund industry is already providing what we call solution-oriented products to make the life of our investors simpler. Typically, if you see investors or the advisors have to track markets if they want to do it on their own, figure out what should, which asset class might do well, and then they have to worry about which funds or ETFs to select in each asset class, right? So there's a lot of time and effort that is involved, not just to build the initial portfolio, but to keep tracking it and making changes, which is called rebalancing, right? So instead of doing all that, investors can just look at some solution-oriented products like the asset allocation fund of funds, which we also provide. So in that, the first advantage is that, you get automatic portfolio diversification. So we provide exposure to 4 different asset classes like domestic equity, international equity, fixed income, and gold, right? And then there's a dedicated portfolio manager who essentially tracks the market and decides, which mutual funds or ETFs to select in each asset class, right? And then they also kind of figure out when to rebalance the portfolio. If, for example, equity markets have corrected, then they will increase the equity allocation. If equity markets have rallied too much, then they will reduce the equity allocation. They'll see how much allocation to make to gold or fixed income and so on, right? So the portfolio diversification ensures that because of the negative correlation between these asset classes, you get stable risk-adjusted returns. It's not like you get positive 20% return one year and negative 15% return the next year. What you really want is like FD plus 3 or 4% return on a consistent basis. So that's the objective of this kind of a solution-oriented product, which is called the asset allocation fund. The other advantage is that it also lowers the cost for investors. So when investors make any changes in their portfolio, typically they have to pay either short-term or long-term capital gains taxes. Whereas when this kind of changes are made in the fund of fund, there are no tax implications for the investor because the fund of fund is also just another type of mutual fund. So until the investors redeem their fund of fund units, they don't need to pay any tax. Lastly, it's very affordable and convenient. So even if, for example, an investor wants to start an SIP or make an investment, even just a few hundred rupees, they can invest that amount in the fund of fund and still they will get the underlying diversification across these different asset classes. The funds or ETFs will be chosen for them and the portfolio will be rebalanced on a regular basis. And they just need to kind of read this one statement of this one fund of fund. They don't need to worry about monitoring statements of 10 or 15 different funds. So it makes life very simple and convenient, gives them the advantage of portfolio diversification. And also there is a dedicated portfolio manager who manages the underlying investments for them.
Okay, so just to clarify to our viewers also, fund of funds are those funds that basically invest in other mutual funds.
Yes.
Yeah. So, so the fund of funds that you're talking about, Mr. Bhatt, I'll continue with you on this point, is that another category that kind of caters to a similar kind of need is the balanced advantage or hybrid funds, as we call it. Right. So what about those categories in comparison to FOFs? Because FOFs, I believe, I'm not too sure, but maybe the expense ratio there would be a little different from balanced advantage funds. So which one do you think is more suitable?
Right. So the biggest difference is, for example, the balanced advantage funds give exposure to 2 asset classes, domestic equity and fixed income, whereas the asset allocator fund of fund gives exposure to 4 asset classes typically, which is domestic equity, international equity, fixed income, and gold. And if you see the historical data for the past 5-10 years of the returns from different asset classes, we see that every year some different asset class has performed well. So one year domestic equity might do well, another year international equity might do well, third year gold might do well, fourth year fixed income might do well, right? So from a portfolio diversification point of view, it's important to have all these 4 asset classes in the portfolio, not just the 2 asset classes that the balanced advantage funds provide. And from an expense point of view, also see that FOFs invest in the direct schemes of the mutual funds and in the low-cost ETFs.
Okay.
And as per the SEBI mandate, they can't charge more than twice the weighted average expense of the underlying mutual fund portfolio. So there is a cap on the expense ratio also. So given the advantages that the fund of fund provides, the expense ratio is quite reasonable because a dedicated portfolio manager is doing all the work and managing the portfolio.
Right. And do you think that it's these are like the perfect kind of funds for asset allocation, or do you think some of maybe the evolved investors who can't who really want to do it themselves can go to assets separately? Like if they want to invest in gold, so maybe they go to a gold fund and equity fund and debt fund and so on. So what do you think about that?
So yes, so to clarify, asset allocation funds as well as balanced advantage funds, they are more suitable. One is, for example, for first-time investors who may not know the nuances of the market, or
Right.
for investors who don't have the time or the interest. Not really everybody is interested in tracking markets on an everyday basis, right? So that is one. Second type of investors are those who don't want too much volatility in the portfolio, right? Like I said, I mean, some investors are okay if they get a positive 20-25% return 1 year and a negative 15-20% in 1 year. So they're okay with the volatility, but some investors don't want that volatility. So even for them, asset allocation funds would be good, because the objective there is to give a FD plus 3 to 4% return on a low volatility, like a lower risk basis, essentially. But if investors have the knowledge and they have the time, they have the interest to track markets, figure out what their ideal asset allocation should be, which funds or ETFs to select in each asset class, then definitely they can do it on their own, or they can have their financial advisor also do it for them.
Sure, sure. So now, coming to Mr. Rao, we've been talking about how mutual funds can help, and these are some ready-made mutual funds that can really come to the aid of investors. But for a person like we were talking, for a person who wants to do it on their own, the asset allocation, what do you think is the ideal debt equity ratio for such an investor?
For this question, probably I'll take it from where Vinod was speaking earlier. Probably the right ideal asset allocation, it depends on the person to person, how you are looking at. It's like the way we talk about the personal finance, even asset allocation, the way you are taking a risk. I mean, it's like, end of it, it is a right mix of investments, which can give the total return. Probably it returns the total return over a period of time, what the investor is looking for it. And each of us will have a different flavor for the different asset classes and different risk tolerance levels. Probably I'll put it is under a 3T framework. The 3Ts are, the first one, what is the time frame you are looking to invest before you are, what is the time frame you are looking at. And second is the tolerance to the risk and tolerance to the declines. And sometimes I feel I have a tolerance to the risk, but when the decline is very higher, I can see, why SIPs get stopped during the corrections period, because once the decline is coming, the risk tolerance is much lower. I mean, when we go to the blood test, it's a glucose tolerance level. Like the way people are looking at their tolerance level are very less when it is looking at when the declines are coming. And the third one is a trade-off between, I can wait for the market correction period that will reduce the NAV for a short period of time, but in the long term, it gives the return. What is the trade-off I'm looking at, between reducing the short-term decline and the long-term return? If I can frame these three into this, probably you can create a right asset allocation, not only equity and debt, probably I will call edge of asset allocation. That is the equity, EDGE, equity, debt, gold, and the last E is the real estate. And what kind of combinations you need to, and what kind of risk you can take. I think, Vinod was mentioning in his book, the ideal combination of debt equity to the gold for the larger people. In one of the conversations he was mentioning is 70, 70, 20, 10 or 65, 30, 65, 25, 15. I mean, sometimes why you need to have a 65 in equity is if it's in the balance funds he is managing, where he can look at, it can give a tax efficient. Probably investors also need to look at the ideal allocation is how that can trade off and how they can get. And there is various models which are available. People can choose as per that. It could be a strategic allocation, or it could be a constant asset allocation, which one, like for example, many of them have a strategic asset allocation, which can work for them. For some people, it's a constant. And that also does work because every corrections you can realign, rebalance it. Then there could be a tactical allocation. People can play with the market. If you understand little more, you are a little more versatile. And the last one could be the very dynamic asset allocation, which is like, during good times, you are with the good assets and the asset is not going to perform as you are aware, you move out and you will have a dynamic asset allocation. And whichever the strategy, ideal asset allocation is, depends on each individual, and the asset class which you adapt is what kind of return you would like to, you intend to get with what kind of risk you are taking in.
Absolutely agree. Asset allocation is about your needs and requirements and your very, very personal circumstances that each investor has. So coming to Mr. Trivedi, you were talking about the last answer when you were talking about was how when people come to the markets, that's not the time to do asset allocation, and it should be started right from the beginning, like right from the beginning when you start the investing journey. But in the past 2 years, I think we saw many young investors entering the market, and we're not too sure whether they did understand the concept of asset allocation, especially because of all the buzz of high values and all of that. So what do you think their strategy should be now? What is it a good time to make a new beginning in that sense?
I recall a quote that is attributed to Warren Buffett, which said the best time to plant a tree was 20 years back. The next best time is today. I think that principle applies to this also. So if you didn't do in the past, do it today. That's okay. I mean, it's not so much about the state of the market. It's all about you've got to make a beginning at some point in time. And if you've not made a beginning, do it today. So that's how I put it. Having said that, I'll just pick up a few things from what Mr. Bhatt and Rao sir was mentioning. How do you start your asset allocation? So let's say in my house there are 4 of us, 3 of us drink tea, and all the 3 prefer different flavors of tea. So I like it strong. My wife doesn't like it strong. My daughter says less milk. Now, there are 3 different people who want it differently. Now, this is all about preferences. But when it comes to the portfolio construction, it is all about one's objectives. And these investment objectives for myself have to be in line with my financial goals. So all the investors who started in recent past without really worrying about asset allocation, my simple request would be list down your goals. And what are these goals? These are nothing but the way you want to live your life, what kind of life that you want to lead, and convert those into financial goals. So for a particular kind of life, I would say, let's say I want a vacation once every 6 months, for example. Then make that as your financial goal every 6 months. So that is the timeline, and allocate some amount, the value to that goal. Of course, that value would keep changing from vacation to vacation and inflation and stuff like that. But at least start with assigning value. So you start with your life, convert it into a financial goal. Once you've done that, then what do you need to achieve that? In certain cases, you need regular cash flow. In certain cases, you need liquidity. In certain cases, you need capital appreciation. Now, these are the primary 3 objectives for any investment program: safety, liquidity, and returns. It's like a, because Rao sir insists, I'll come to Bollywood. It's like a, Hindi movie where you have a hero, you got a heroine, you got a villain, you got a comedian. That is asset allocation in the Hindi film, or a character actor or character actors. So you've got that, you need those components to make a solid movie. Of course, the script, etc., direction, that those things also matter a lot. And if you extend it, that also is part of asset allocation, how you approach it. But coming back to investors' objectives, once you define the safety, liquidity, returns objectives, then you have to pick up funds which have the potential to fulfill those objectives. So an equity mutual fund can provide long-term capital appreciation. A debt fund has a potential to provide safety with probably a regular income, and a liquid fund would offer liquidity. Now add a couple of other asset classes. You look at gold, for example, and you can put it in the long-term portfolio because there is no current income. Once you put these things together, so you've got investment objectives of the investor, and you've got investment objectives of the schemes, and then now you start matching. Because each investor's objectives are different, each one would get a different portfolio. And that's why asset allocation becomes personal. So my tea will be stronger than what my wife prefers.
Right.
And I can't drink the tea that she does, and she doesn't like the tea that I drink. Okay, so it applies to every investor. Put these things together. Now, if you are not able to do this, take professional help. And I think most people will not be able to do it. Take professional help. Take help of a mutual fund distributor or an investment advisor. Go and discuss these plans, ideas, etc. And if required, as Mr. Bhatt very beautifully explained about the balance advantage funds or the other asset allocation fund of funds or other hybrid funds, I think these are also combinations. So I take my dal and chawal separately, or I take khichdi and eat it. So that's your hybrid fund. The khichdi is the hybrid fund where both you combine both dal and chawal. What do you want to achieve? There are solutions available within the mutual fund basket. Not each solution may be applicable for each investor. And that's why that entire exercise of doing the right asset allocation must be conducted in order to get that edge of asset allocation browser.
Right. So we've all been talking about this, how asset allocation depends on an individual's needs and requirements, circumstances, etc. So, Mr. Bhatt, do you think, considering that, the different varied needs of people and investors, should there be different strategies of asset allocation? In fact, I believe there are. So could you elaborate on that, on what kind of strategies that investors can undertake for asset allocation?
Yes, so see, typically, one can follow either a quantitative strategy where you use some models, some numbers to support your decision, or one can follow just a purely qualitative strategy where you just analyze or think about what's going on in the markets and different asset classes. Or third is a mix of the two, where you use both, a model to support your decisions and then some human intervention to take the final decision, right? And you will see that typically in balanced advantage funds or hybrid funds or asset allocation funds, there is a mix of the two. So even in our asset allocation fund, for example, we start with a quantitative model which looks at various valuation metrics and gives us some signal as to what should be the allocation to different asset classes. But you can't just rely 100% of the model, because at the end of the day, it's like, garbage in, garbage out. Like, for example, during COVID, what happened was the earnings of all the companies, declined dramatically. So the price to earnings ratios got artificially inflated. And all the models suggested reducing equity, because typically when the valuation multiples are higher, the model suggests reducing equity, right? But we understood that, that was not the right signal. And hence we maintained our equity allocation during that period. And that's where the human element comes in, right? So the second step, once the model gives us some signal, the second step is that we take inputs from our fund managers, from our analysts, and the strategists. We take inputs from our economists. So we bring all this together, and then we take the final decision, right? So that's what, if somebody wants to do this on their own, right, or go through a financial advisor, that's what they would have to do. Ideally have a mix of a quantitative model that gives some signal and then a human overlay. Because also what happens is, if you don't have some quantitative backing, if the market crashes 40-45%, like what happened March, April 2020, most of us would not have the courage to put our money in at that time. Okay. And what the model does at that time, it gives you the confidence that, hey, valuations have fallen. So you increase your equity allocation. Or if the market rallies very quickly, then most of us would think that, market has rallied, it can continue going up. But what the model will tell you is, hey, listen, the market has rallied very quickly, valuations have risen, so please reduce your equity allocation, right? And that's what helps us to act and overcome our behavioral biases. So that's what, you can follow either quant strategy or just a qualitative strategy or a mix of the two. Best is to follow a mix of the two.
Okay, that's a very, very interesting point that you have raised, that, that whole issue of human biases. I think everybody experiences that. Most investors experience that in different forms. And this is, of course, a very important example when it comes to market behavior. People's behavior get, affected accordingly. Spoken about how asset allocation can really help us. But are there any pitfalls of not doing asset allocation? Could you elaborate on that, Mr. Rao?
Thanks, Nidhi. I mean, apart from the strategies, sometimes we try to get the best of the strategies, and it may work and it may not work. And, like for example, if I'm playing a T20 and I have lot many fast bowlers, and the pitch is going to be the spinners one, then, if I'm not having a right combination, there is a match I'm going to lose. Either way, sometimes I may win without even having a fast bowler, but only spinners. Means one single asset class can perform for longer run, and if I'm sticking there, I may do well. And diversification does not need to work 100% of times. But let me tell you, there is a research paper which is available. I think it's a Gary Brinson 1986, which is the first paper which I was reading about. 93% of your portfolio return comes out of asset allocation. Later, many papers suggest 85 to 90% of your portfolio returns are coming from the asset allocations. And only 10% of the times or 15% of the times it may not performing, because in the market, last 2 years, I would have seen if I have an exposure to my, like, if I have a right asset allocation, still if I am not exposed to equity right, I would not have made money. Similar thing some time back. That's where. And there is another way. The biggest pitfall is like people too often change their asset allocation. Um, and there are people whom the investors I have seen, they never look at changing the asset allocation, irrespective of the market conditions. And and it's like timing in the market or time in the market kind of it. And sometimes we are owning, under owning, or sometimes we are over owning the one asset class. That's another way we can look at. And sometimes we are too aggressive. Sometimes we are too conservative. And last but not the least, the why we fail is we do not have an if someone is not having a right plan, and that's where the entire stuff will come back, and you just invest for the sake of investing and you don't make money, and we blame. There is a time auto asset allocation will work. That's time asset allocation funds will work. There is a time hybrid funds will work, because you don't need to do everything. Then that will come. And somebody rightly put it. I have all the assets, all the asset classes, the four asset classes: equity, debt, gold, and real estate. But what the other asset class I have in my mind is the three things which can pep up my investments. Is the first P is the pep up, is P is the patience, and the second is my experience during good times and bad times, and the last one is the perseverance. And to have that returns to get, I need to get that pep up, then I can have that edge. And last but not the least, I can say is in the mutual funds, when it comes, you may have a best of the asset allocation. There's a triple A art of asset allocation, and there is a triple S which can work, which is the science of scheme selection. And when you don't know the science of scheme selection, just stick to the asset allocation fund. And I call, during our programs, I call the science of scheme selection, the triple S. I call it as a Satyam, Shivam, and Sundaram. The scheme should be Satyam, the truthful to the mandate given. And Shivam is it should give the right returns and right processes. And Sundaram is it can give the beauty can come when you manage it right for the long term. And that is the fund you can choose. Then you are at home.
So, okay, that's an interesting analogy. So, whether our investors want to stick with Satyam, Shivam, Sundaram, or Amar, Akbar, and Anthony is their choice. Of course, it's just a way of saying the same thing in two different, very interesting ways. So, your last word on the topic, Mr. Trivedi.
I've got two things to say out here, and because Rao sir started with Amar, Akbar, Anthony, I can't resist myself from mentioning Mr. Amitabh Bachchan. When you invest in any asset category, remember that the superstar of the millennium, Mr. Amitabh Bachchan, also gave some flop movies. So even the best of the asset category will undergo some periods of underperformance, and it does not mean that you got to get out of those, right? So that's point number one. Now, how do you ensure? Because Rao sir also mentioned one beautiful thing that people keep changing their asset allocation, and my experience suggests that that change in asset allocation largely is on account of the fear and greed that people oscillate between, often on account of the immediate past performance. So whatever has happened in last 6 months, or whatever is the world is chasing, and that's what people really chase. And that's where again I'll invoke Mr. Bachchan. In the movie Kalia, his famous dialogue was that हम वो है जो कभी किसी के पीछे खड़े नहीं रहते, हम जहाँ खड़े होते हैं लाइन वहीं से शुरू होती है. But most investors follow it exactly inversely. They say जहाँ line होती है वहाँ हम खड़े हो जाते हैं. So when everybody is buying, if I'm in the queue, I'm not going to make money. So let's understand that as well. So how do you create your own line? मेरी अपनी line कैसे मैं बनाऊं? The only way to do is start with your goals, decide your asset allocation in order to achieve those goals. And then, because your life and your goals are going to be unique to yourself, your line would be very different, and you don't have to stand behind somebody in the queue. I think if we take care of this part, a lot gets taken care of. Now, how do I ensure that even after doing this, over a period of time, I don't lose belief and I stick to this particular plan? And that's where the models that Mr. Bhatt was mentioning come into picture. The quant model or qualitative model or a combination of the two. I think a combination of the two makes immense sense simply because when there are rules formed, you stick to those rules and the rules start dictating, but the human aspect comes in, the judgment comes in as a sort of refinement of those rules, and periodically the human judgment also changes those rules. The last thing that I would add to this rule-based versus human-based approaches, because all of us are humans, we are vulnerable to making mistakes, and that's where we need some guidance, some coaching, and that's where taking professional help makes a lot of sense.
I would agree on that. That taking professional help makes a lot of sense, especially for retail investors. And thank you so much, gentlemen, for your insights on this very important topic. And for our viewers, of course, there were so many takeaways. There are different strategies that you can use. We spoke about how you can be patient and persevere a bit and look at different instruments to really do it right, to bake the cake right, as Mr. Rao had put it. And of course, the industry has the right kind of products to help you do that, as Mr. Bhatt elaborated during the conversation. So thanks a lot, gentlemen, for sharing your insights and being part of this conversation. And good day to our viewers.